I just think that they're wrong on the law. And I think that the investment of money prong means money, investment of actual money.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin, author of The Cryptopians. I started covering crypto 9 years ago, and as a senior editor at Forbes, was the first mainstream reporter to cover cryptocurrency full-time. This is the September 20th, 2024 episode of Unchained.
Looking to elevate your crypto trading? Get zero trading fees, boosted rewards, and priority support with Coinbase One. Get a free month with code UNCHAINED at coinbase.com/one. FBTC is the fastest growing omni-chain BTC asset this summer. Join FBTC Points-inspired campaign where you can hold FBTC to earn sparks, lucrative yields, and token drops, all on your Bitcoin. Where can you find $700 million in real-world assets, 11 million daily operations with industry-low fees, powered by 450,000 plus on- and off-ramps across 180 countries? The Stellar Network. With iTrust Capital, you can buy and sell crypto in a tax-advantaged retirement account. Enjoy significant tax advantages, 24/7 access, and the industry's lowest fees. Polkadot is the original and leading Layer 0 blockchain with over 2,000 plus developers. And the Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem. Join the community at polkadot.network/ecosystem/community.
Today's guest is Amanda Tuminelli, Chief Legal Officer at the DeFi Education Fund. Welcome, Amanda.
Thanks for having me.
This week, Republican Representatives Tom Emmer and Patrick McHenry sent a letter pressing SEC Chair Gary Gensler for clarity on how securities laws apply to airdrops. Give us the backstory here. How was it that airdrops came to be viewed as potential securities offerings?
Sure. So I was actually really pleased to see this letter come out because the SEC has taken this position over a number of years that even a free airdrop, even to unsuspecting users, the SEC says that can still constitute a securities offering when digital assets are given for free to people. And as Representatives Emmer and McHenry point out, that really doesn't make sense under the Howey test, right? Howey requires there to be an investment of money, and there is no investment of money when there's a free airdrop. But the SEC's taken this position in a number of cases, which are cited in the letter. There's the Tomahawk case, the Hydrogen case, the Justin Sun case, and they even cite the Uniswap Wells notice response because there was an airdrop at issue with Uniswap.
And so what is the SEC's theory, and why are Representatives Emmer and McHenry questioning whether it's been misapplied?
So it seems like from their letter, they understand the concept that the Howey test requires an investment of money. The SEC takes the position that even when there is a free airdrop of tokens, if the token creator asks people to do something in response or do something to in order to receive the free airdrop, like promote on social media, or in the Justin Sun case, there was like an emoji contest, like asking people to participate in an emoji contest, according to the SEC, counts as compensation that they're saying counts as an investment of money under Howey. And of course, they've not really articulated it as specifically as that, but that's what you can glean from the various complaints that they have filed against people in the space.
Oh, so it's more like it's an investment of time or effort. Is that kind of the thinking?
They're saying that even just liking something on social or promoting something on social counts as compensation. So something like money back to the token creator. So they're saying there really is an exchange of tokens for compensation. It's not a free airdrop. It's an airdrop in exchange for marketing and promotional value. Now, I don't think that's how the Howey court would agree with that. I think money means money, but I think that's the SEC's theory, is like even any kind of services in response for the token could count as compensation.
Okay. And so this also relates to a lawsuit that your organization, the DeFi Education Fund, has brought against the SEC, asking it to clarify for a company called BEBA's airdrop that, they'd like to airdrop these free tokens for marketing purposes, and you're asking the court to clarify that this is not a securities transaction. So what's your argument in that case?
Sure, yeah. So it's exactly getting at the same issue we're talking about. So BEBA has asked the court to declare that its free airdrop of BEBA tokens was not a securities offering and that the tokens themselves are not securities. But in that case, BEBA did a free airdrop of tokens to unsuspecting users, and that token entitles the token holder to have a discount and access to an exclusive duffel bag. Without the token, you can't access that sale for the duffel bag. But the token itself is just entitles the bearer to that discount and access. So after doing that first airdrop, BEBA plans a second airdrop. And in the interim, we filed our complaint asking the court to declare that the first airdrop and any future airdrops would not be securities offerings.
And what is the current status of the lawsuit?
So the SEC moved to dismiss the amended complaint last week, and our opposition to the motion to dismiss is due next month. So we're really at the early stages here. The motion to dismiss is just based on the allegations in the complaint. And, hopefully we'll get past the motion to dismiss and get to discovery and, take this all the way and get the declaration we're asking for.
What would be the timeline you'd expect for that?
So unfortunately, litigation can take a really long time. In addition to that declaratory judgment claim, we have a claim under the Administrative Procedures Act saying that the SEC's regulation by enforcement campaign is against the APA, that it violates the APA, and we want discovery on that claim. So discovery could end up taking a long time, but if we get discovery, it could show that the SEC does have an internal policy on how it views digital assets and how it is applying the law to digital assets according to the SEC. So that could take months, if not years, but hopefully not. Hopefully it will be, hopefully we'll get to the merits in at least, in a year, maybe.
So it seems that some crypto lawyers think that the clarity around airdrops being securities is actually pretty strong. They say that this is part of a consistent policy by the SEC over decades. For example, Gabriel Shapiro, who most people on crypto Twitter would know, he's definitely a very pro-crypto, tends to be very anti-SEC type person. But he tweeted, quote, "I love a good Gensler ribbing as much as the next guy, but the SEC did basically clarify its ultra-aggro position on token airdrops in the Tomahawk exploration case. And the position is consistent with the free stock cases of the 90s. We may disagree that the position is correct, but it's not unclear." What do you have to say to his tweet?
So I actually think he's right that the SEC's position is clear. I just think it is also wrong. So I think that, as he said, the Tomahawk case, the Justin Sun case, the Hydro case, the SEC has told us that they think this. They think free airdrops of tokens can be securities offerings. So I don't disagree with him there. And I understand the allusion to the free stock cases, because in those cases, the SEC took the position that I think in those cases, the fact was that if you put in your email address and in response to your email address, you get free stock, that counts as compensation to satisfy the Howey test investment of money prong. So I agree with him that that would be the precedent the SEC would cite to support their position. But I just think that they're wrong on the law. And I think that the investment of money prong means money, investment of actual money.
Okay. So many crypto projects have restricted U.S. users from claiming airdrops, but these have easily been bypassed, these restrictions. And you might have seen CoinDesk recently reported that EigenLayer employees were claiming tokens from airdrops in the EigenLayer ecosystem that were technically blocked to U.S. users. And I wondered if you thought projects should implement stricter measures to ensure users don't claim these airdrops, or generally what you think of, how a lot of users apparently are trying to bypass them.
I mean, I think that I can understand why people want to claim free airdrops of tokens, of course. And I think that going back to first principles, crypto is about creating community, and giving people tokens to participate in a community is exactly, why crypto was created in the first place. I think that I think this reflects that projects are struggling to figure out what the actual law is and what the regulation is that they need to comply with. So if it were clear what geofencing would actually satisfy regulators, I think we would see more compliance with that. It's just that right now it's really not very clear what is sufficient to a regulator.
And airdrops also basically became a trend because initial coin offerings became a target by the SEC. So if we eventually come to a position in the U.S. where airdrops are not an acceptable way to distribute tokens, initial coin offerings are not, then what does that future look like? Will crypto projects mainly just start outside the US and Americans will have to buy in if they want to participate? Or what do you think would be the best solution?
So that's really uncertain. I think, as you said, it could be that projects will move overseas, which is something that the industry has been warning Congress about here, is you're going to lose your ability to interact directly with token creators and projects. We're going to lose innovation to other countries, I think, or people are going to have to pick an exemption and try to do an offering. This all is, of course, presuming that tokens themselves are securities and that we have reached a place where that is clear. So if we're talking about a world in which the SEC is regulating token offerings, then I think people will have to find an SEC exemption to offer tokens pursuant to. But, I think there are some precursor questions we need to answer, like, are tokens securities, and is the SEC the regulator that we need to be complying with? And I think those questions are for Congress.
All right, so in a moment, we're going to talk about other issues related to the SEC and regulations around crypto. But first, a quick word from the sponsors who make this show possible.
Coinbase One is a membership with over 400,000 crypto traders worldwide. As a member, you get elevated perks such as zero trading fees, up to 5.6% APY on USDC, boosted staking rewards, and 24/7 priority support. Experience it free for 30 days with promo code Unchained at coinbase.com/one. FBTC is an omni-chain BTC asset contributed by Mantle Network and Alpha Global. Launched in early July, FBTC's TVL has already passed $125 million, making the fastest growing BTC asset this summer. FBTC's points-inspired campaign, Sparkle, has officially started, with lucrative and sustainable yields, plus points and token airdrop from Babylon, Mantle's new token cook, and more. FBTC is the BTC solution you've been waiting for. Visit fbtc.com/ongoing-campaign today. The Stellar Network is built to power real-world solutions that will onboard the next billion people. Build a future-proof dApp underpinned by more secure Rust smart contracts, transactions confirmed in seconds, and a predictable fee structure that scales. Find product-market fit with one of the fastest-growing DeFi ecosystems and a user base of millions in emerging markets worldwide. Deliver real-world utility on a network with more than 16 billion network operations. Build better. Build on Stellar. Head to stellar.org to learn more.
Back to my conversation with Amanda. So while all this is happening, meanwhile, the SEC has shifted how it talks about crypto. They put a footnote in their amended Binance complaint that said, quote, "As this court noted and as the SEC reiterates, with its use of the term crypto asset securities, the SEC is not referring to the crypto asset itself as the security. Rather, as the SEC has consistently maintained since the very first crypto asset Howey case the SEC litigated, the term is a shorthand. Nevertheless, to avoid any confusion, I don't know what this PAC is. What's PAC?
I think they're talking about the amended complaint there. They're referring to their own document.
Okay. The PAC no longer uses the shorthand term, and the SEC regrets any confusion it may have invited in this regard. So crypto lawyer Twitter was both outraged and a bit mocking about this footnote. So I wondered if you could talk a bit about the evolution of this language. How has the SEC used it in the past? What are they changing it to? And why are they changing it?
Yes, I think we all had a visceral reaction to this footnote, especially the fake apology for any confusion it may have caused. I mean, talk about the understatement of the year. So what they're referring to in their own footnote as dating back to the Telegram case, I think is such a disingenuous cite. Just to nerd out for a second, what they are citing there is, you would think they're citing themselves, right? Because the sentence before the cite is, as we have maintained since the very first case. So you'd think they'd be citing something they wrote. They're not. They're citing the Telegram court opinion. So it's almost like saying, well, the court has been clear maybe on whether the assets themselves are securities, but the SEC has not. And I think that's the point. If you look at, I think, almost every complaint they have filed in this space, they repeatedly say the tokens are investment contracts, or, whatever it is, token X was offered as an investment contract. And in many cases, like in the Ripple case, for example, they take pains to say XRP is not a currency, it's an investment contract. So clearly, they did think the tokens themselves were securities, but because that has not been a winning litigation position for them, they are now taking the litigation position that they've never thought that the tokens themselves are securities, and that's just shorthand. I think that that's an advocacy position. Like, that's not the objective takeaway from their enforcement actions in the past.
And wait, so what, like, I guess what's confusing is the Telegram case is from a while back. So why are they changing it now if they're saying, like if that was the first time that happened, then why are they only admitting it now?
So I think because they've been losing on this point over time, right? Judges have now gone out of their way. Like in the Ripple case, Judge Torres said the tokens themselves are not securities. Even Judge Rakoff said in the Terraform Labs case, he said the tokens themselves are not securities. He, of course, goes on to write an opinion that is not otherwise helpful to the SEC. But in almost every case where this has come up, the judge has said the tokens themselves are not securities. So I think the SEC has recognized, especially recently, that that is not going to be a winning position for them. So now they're like falling back to this position of, well, we never meant that. We meant the tokens plus all these other things are somehow packaged together and offered in that whole collection as an investment contract. And I think they need to take that position in order to have a sensical position in the secondary markets cases, right? Like all their cases against major exchanges, they need something to travel with the token to the secondary market. Otherwise, their position makes absolutely no sense.
Okay, so does this then mean that their new argument is this sort of like ecosystem argument, or what is their new argument?
I mean, this might be an unpopular opinion, but I think their new argument is actually an old argument, which is the embodiment theory. I think what they're really saying here is like the token embodies the investment contract, and somehow attendant rights and obligations are somehow like packaged with the token, and then the token is offered as an investment contract along with these rights and obligations. And I think, like I said, they need to take that position for their exchange cases to make sense. Because if it's just the token, then the secondary sale of a token without anything else, if you assume the token's actually not the security, is not a security sale. So they need to take the position that something goes along with the token in the secondary market sale in order to have their Coinbase and Binance and Kraken cases make sense.
Okay. At this point in time, just in this sort of like long-standing battle between the SEC and crypto, where do you think all of this is headed? Like, if you're looking at all these different court cases, do you have a prediction on where you think things will end up?
I think like it is going to cause a gray area, and it's going to change based on what court you're in front of, right? It's going to be what the judge in the case in front of the SEC thinks in that particular case until we get to an appellate court level or even a Supreme Court level, or until Congress acts. Because, you have several cases ongoing right now where the SEC is taking this position. And I would say that this footnote in Binance actually signals a shift in how they've been thinking about crypto asset securities. So all the cases that have already been filed, like, I'm almost wondering, are they going to go back to those cases? Like, are they going to go tell the Coinbase judge, Judge Fela, actually, when we said crypto asset security, that was shorthand. That's not what we really meant. I haven't seen that filing go in, but maybe they are. So I think they're causing chaos, right? Instead of acting like an objective and neutral regulator, I think they're acting like litigants. They're acting like adversarial litigants.
And Gary Gensler, the SEC chair, is set to testify next week before Congress. So I don't know what you are expecting or what you're curious to hear from him on any of these issues about, that are involving crypto and the SEC.
I mean, I think they should make him define crypto asset security. I think that they should say to him, okay, so if the token itself is not a security, as you've now arrived at that conclusion, what and who should register with the SEC, and what should they register as? I'd love them to ask him that question. And, I think Rebecca Reddick actually articulated that question very well in the past. So I'm plagiarizing her a little bit here, but I think that is the key question. If the token's not the security, then what is getting registered and who is registering?
Okay. And so recently, we also had the first congressional hearing on DeFi, and you were one of the witnesses. What were your takeaways on that?
So I was very honored, of course, to be invited to speak at the first DeFi hearing, and it was a great panel. Rebecca Reddick, Brian Avello, and Peter Van Valkenburg, we all sat next to each other and talked about what DeFi is, why it's valuable. And there was real engagement by the members of Congress on trying to understand DeFi and why it's good. There was also some less helpful engagement about why, in certain people's minds, DeFi is associated with criminal activity, but that was to be expected. And I think the hearing actually went better than anyone even thought it would, because there really was true curiosity and true engagement with the tech.
All right. Well, last question. Here we are in the last few weeks before the presidential election. And I wondered what you thought in terms of, whether or not it mattered, who would win for crypto regulation, and kind of what you were expecting for each of the candidates if they were to win.
So it is certainly, the crazy run up to November 1st. And you're seeing that in crypto Twitter and everywhere else. People are picking sides. And at DEF, we are nonpartisan. We believe crypto should be nonpartisan, and we will work with whatever administration is next. And, the American people decide elections. So I don't know what's going to happen, but I know that whoever is the president, we are going to most likely be talking about some kind of market structure legislation next year. And I think, who they put into place at the SEC will matter. Who they put into place at the CFTC will matter. And we'll just have to be working with those people and in good faith, and hopefully the members of Congress will also be working in good faith to actually pass legislation that makes sense.
Do you have a preference for who would be the SEC chair if it were Trump, and also if it were Harris?
I mean, not Chair Gensler. I don't have, in my fantasy world, I think Hester Peirce becomes the chair, but I don't know if she would take the job if it was offered to her.
Yeah, well, I think that would only be if Trump were elected, right? Because isn't it that it's a commissioner who's of the same party or something that they... Okay. Well, all right. Well, we'll see what happens. Thank you so much for sharing all your thoughts on Unchained.
Thank you for having me.
Don't forget, next up is the weekly news recap, today presented by Wondercraft AI. Stick around for This Week in Crypto after this short break.
Polkadot is the original and largest Layer 0 blockchain with over 2,000 plus developers. The anticipated Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, upgrading the infrastructure with 8 times higher transaction throughput and twice as fast block times, tailored core time for the needs of every protocol, trustless bridges to multiple chains, and revised tokenomics with a token burn to reduce inflation. Perfect for GameFi and DeFi to build, grow, and scale. Get your Web3 ideas to market fast. Think big, build bigger with Polkadot. Join the community at polkadot.network/ecosystem/community. Did you know you can buy and sell crypto with tax benefits in an individual retirement account or IRA? iTrust Capital makes this possible. But what does this mean? When you buy crypto outside an IRA, like on an exchange, you face taxes on gains. But in a Roth IRA, gains would be tax-free. iTrust Capital also has the lowest fees in the industry and 24/7 accessibility. Start now and maximize your retirement savings with iTrust Capital.
Welcome to this week's Crypto Roundup. In today's recap, we cover the Federal Reserve's recent interest rate cut and its effects on crypto markets, Sam Bankman-Fried's appeal citing bias in his trial, and Vitalik Buterin's thoughts on the new era of crypto usability. We'll also dive into Coinbase's response to rumors about Bitcoin IOUs with BlackRock, Donald Trump's latest crypto push through his DeFi project, the SEC's controversial exemptions to crypto custody rules, and BlackRock's new report positioning Bitcoin as a unique hedge. Plus, updates on Alex Mashinsky's legal battle and Binance founder CZ's upcoming release, along with Revolut's stablecoin plans. Thanks for tuning in to the weekly news recap. Let's begin. Fed cuts interest rates for first time since 2020. In a significant macroeconomic development, the U.S. Federal Reserve has cut interest rates by 50 basis points, marking the first reduction since March 2020. While the move is primarily aimed at managing inflation and economic activity, it has strong implications for cryptocurrency. Rate cuts can often signal a more favorable environment for risk assets like Bitcoin. Even though the initial market reaction was muted, Bitcoin surged from $60,000 to around $63,500 on Thursday morning. Arthur Hayes, co-founder of BitMEX, warned that crypto markets might initially drop after the rate cut, citing narrowing interest rate differentials between the US dollar and other currencies. Mike Butler, an options trader, added that volatility in fiat currencies might drive more people to crypto, reinforcing its role as an alternative to traditional financial systems. Sam Bankman-Fried appeals conviction, cites judge's bias. Sam Bankman-Fried, the former CEO of collapsed crypto exchange FTX, has filed an appeal against his conviction on fraud and money laundering charges. Bankman-Fried, who was sentenced to 25 years in prison, argues that the trial was unfair due to alleged bias by U.S. District Judge Lewis Kaplan. According to the appeal, Kaplan consistently favored the prosecution, ridiculing Bankman-Fried's testimony and undermining his defense team. Bankman-Fried's lawyers claim that Kaplan's actions created an atmosphere of prejudice, which influenced the jury's decision. They also allege that the court unfairly restricted evidence showing FTX's potential solvency, which could have painted a different picture of the company's financial state. His legal team is pushing for a new trial to be conducted under a different judge. Vitalik Buterin says crypto's usability era has begun. Speaking at the Token 2049 conference in Singapore, Ethereum co-founder Vitalik Buterin said that while the crypto industry is no longer in its infancy, it is now entering a phase where usability is vastly improving. "We're not in the early days anymore," Buterin said, highlighting how cryptocurrencies such as Bitcoin and Ethereum have existed for over a decade, yet practical adoption has lagged due to issues such as high transaction fees and difficult user experiences. Buterin pointed out that Ethereum's fees have significantly decreased thanks to upgrades like EIP 1559 and Layer 2 solutions, such as Optimism and Arbitrum. "Current ETH transaction fees are basically zero," he noted, underscoring the impact of these developments on user adoption. He further argued that crypto doesn't have to compromise decentralization for mainstream usability, saying, "We need to satisfy the needs of mainstream adoption while holding on to decentralization values." Coinbase denies allegations of Bitcoin IOUs to BlackRock. Rumors surfaced recently accusing Coinbase of issuing uncollateralized Bitcoin IOUs to BlackRock, fueling concerns of potential market manipulation. Crypto analyst Tyler Durden claimed the exchange allowed BlackRock, which manages the largest spot Bitcoin exchange-traded fund, to borrow Bitcoin without proper collateral, allegedly enabling price manipulation. These accusations gained traction after Tron founder Justin Sun criticized Coinbase's wrapped Bitcoin product, CBBTC, for its lack of proof of reserves and susceptibility to government seizures. In response, Coinbase CEO Brian Armstrong swiftly refuted the claims, clarifying that all ETF transactions are settled on-chain within one business day. Armstrong explained that institutional clients have access to trade financing and over-the-counter options before trades are fully settled. Durden has since deleted his original tweet. Industry experts, including Bloomberg ETF analyst James Seifert, dismissed the rumors, calling them baseless conspiracy theories. Seifert also emphasized the importance of transparency, urging ETF issuers to share digital wallet addresses to prevent misinformation and increase trust in the market. Trump promotes crypto on X Space, advocates for DeFi project World Liberty Financial. On Monday night, Donald Trump appeared on an X Space to promote his DeFi project, World Liberty Financial, and reiterated his strong support for the cryptocurrency industry. Trump criticized the Biden administration and the SEC for their hostile stance on crypto, warning that the U.S. risks losing its leadership in the sector if Democrats win in November. He emphasized the need for a legal framework to regulate crypto while maintaining innovation. Despite the event being billed as an opportunity to reveal major details about WLF, Trump and his team provided limited details. They announced the project's governance token, WLFI, which will be sold to accredited investors, with 63% going to the public. However, the lack of clarity led to skepticism among many in the crypto community. Odds that Trump would launch a token before the election plummeted from 71% to 24% on Polymarket, as users bet against the token launch, citing vague promises and concerns over the project's viability. SEC grants exemptions to crypto custody rule, raising industry concerns. The SEC has revealed that certain financial entities have been granted exemptions from SAB 121, a controversial accounting rule that has faced backlash for its stringent requirements on crypto custody. Introduced in 2022, SAB 121 mandates that institutions holding crypto assets must list them as liabilities on their balance sheets, making crypto custody cost-prohibitive for many firms. In a speech, SEC Chief Accountant Paul Munter disclosed that some banks, brokerages, and blockchain entities have been exempted from this rule. For instance, banks working with state regulators and ensuring asset returns in the event of bankruptcy can avoid these liabilities. However, the lack of transparency around which companies have received exemptions has led to criticism from industry experts. Crypto advocates, such as Senator Cynthia Lummis, voiced frustration, accusing the SEC of making policy through closed-door meetings rather than revising SAB 121 directly. BlackRock highlights Bitcoin as a unique hedge in new report. BlackRock, the world's largest asset manager, has released a report describing Bitcoin as a unique diversifier against global risks. In the 9-page white paper, the firm explains that Bitcoin, while volatile, operates independently from traditional asset classes and is minimally affected by macroeconomic factors. This detachment, BlackRock argues, makes Bitcoin a valuable tool for hedging against risks such as monetary instability, geopolitical tensions, and fiscal concerns. The report notes that Bitcoin has outperformed other major assets in 7 of the past 10 years, despite remaining risky. BlackRock, which launched one of the most successful spot Bitcoin ETFs earlier this year with over $21 billion in assets, sees Bitcoin's potential to serve as a flight to safety during global uncertainties. The firm also highlights Bitcoin's decentralized nature, free from traditional counterparty risks, as a key factor in its appeal to investors seeking alternative financial assets amid growing economic challenges. McHenry seeks witness testimonies, CZ set for release. Former Celsius CEO Alex McHenry, facing a potential 115-year prison sentence, has requested testimony from 6 key witnesses for his defense. His lawyers argue that McHenry never intended harm and relied on his Celsius team for decisions, including those regarding Celsius's token, CL. Among the proposed witnesses is former Chief Revenue Officer Ronnie Cohen-Pavon, who pled guilty to charges of manipulating the price of CL. McHenry's defense maintains that Cohen-Pavon and other employees acted without his knowledge. Meanwhile, Binance founder Changpeng CZ Zhao is set for release from prison on September 29th after serving nearly 4 months for violating the Bank Secrecy Act. Zhao pled guilty to failing to establish proper KYC protocols at Binance and agreed to a $50 million fine. Following his guilty plea, Zhao stepped down as CEO, and Richard Tang, a former regulator, took over leadership of the exchange. Revolut prepares to launch its own stablecoin. London-based fintech giant Revolut is reportedly in the advanced stages of creating its own stablecoin, according to sources familiar with the matter. The move aligns Revolut with other major players like PayPal, which launched its PYUSD token in 2023. However, the stablecoin is unlikely to be available in the United States due to Revolut's previous exit from U.S. crypto services amid regulatory challenges. Revolut, which has grown to 45 million users and recently secured a UK banking license, is focusing on expanding its crypto offerings. A spokesperson for the company told CoinDesk, "Crypto is a big part of our belief in banking without borders, and we aim to become the safest and most accessible provider of crypto asset services." And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.substack.com. That is unchainedcrypto.substack.com and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aronovich, Megan Gavis, Pam Majumdar, and Margaret Correa. The weekly recap was written by Juan Aronovich and edited by Nelson Wang. Thanks for listening.
Unchained is now a part of the CoinDesk Podcast Network. For the latest in digital assets, check out Markets Daily, 5 days a week, with host Noel Atchison. Follow the CoinDesk Podcast Network for some of the best shows in crypto.